A warm welcome, friends, to this new chapter called The Understanding of Cash Flow Statements. And it is part of CFA Level 1 and useful for any finance student from any domain. Here we try to understand the different sources of cash inflow and outflow and how they are categorized under both IFRS and US GAAP, and what is the significance of each of those items, and how an analyst can look at these items and try to decipher or make judgments about a company and its current status and its future status also. So friends, let's start our journey. Cash and non-cash items. So friends, in a profit and loss statement, for example, there are certain items like sales, then there is cost of goods sold, then there is financial expenses, then there is depreciation and amortization, and then there is taxes, then there is net income, right? Items proceed like this. Now from these, certain elements like sales, these are actually representing cash, right? Sales actually represents cash. On the other hand, depreciation and amortization is basically a non-cash item. Why? Because some investment has been done, say 5 years back or 1 year back or maybe this year. And this investment, let's say it is of 100 million, and the useful life of that asset where it is invested is 20 years, right? 20 years. Therefore, every period for these 20 years, each year 5 million will be added in depreciation and amortization. Instead of subtracting 100 million in the beginning only, what will be done is basically this item will be capitalized, which means the entire useful life will carry the cost of it in a distributed manner, which implies that this depreciation and amortization is a derived item. It's a derived item. It's not a cash item. It's a non-cash item. Similarly, an interest expense is a cash item. You have actually paid the interest, right? You have paid the interest, so it's a cash item. So like this, there are cash items and non-cash items both in balance sheet and profit and loss statement. Sources of cash inflow and outflow. There are mainly three sources of cash inflow and outflow. They are investments, operations, and financing. Now we will understand each of these items separately, friends. First comes cash flow from operations. Now, these are basically cash inflows and cash outflows with regards to operating activities. Let's take some examples. Let's take a few examples of cash inflow from operations. What can they be, friends? Cash inflow from operations. This is basically proceeds from selling the main products or services plus trading securities. These are basically sources of cash inflow from operations. Now let us take example of some cash outflows. CFO minus, that is cash outflows. This is paying salaries, finishing product from inventories, right? Converting inventory into a finished product, delivery of the product, marketing expenses, etc., etc. So these are examples of cash outflow from operations. Now one must remember, trading securities is different from buying and selling securities for investment, right? That falls into the investment category. The main difference is basically the intent and the time horizon. Trading securities is mainly looking at changing hands of the securities rather than earning some periodic income from it. That is the main difference. Now we will go into cash flow from investments. So friends, let us first discuss a few examples where there are cash inflows from investments, CFI plus. This can be selling of some asset, selling of some securities, selling part of the property, plant and equipments, selling a license, which is basically an intangible asset. These are examples of cash inflow from investing. A few examples of outflows: obviously buying assets, buying securities, right? Then buying property, plant and equipments, buying land and PPE, buying licenses or technologies, buying patents. These basically result in cash outflow. Sorry, I have mentioned the sign wrong here. This will be negative. So again friends, examples of cash outflow from investing: buying assets, buying securities, buying land, property, plant and equipment buying licenses, patents, etc. These result in cash outflow from investing. So we are looking at long-term assets being sold or bought. That is creating what we call cash flow from investing. Now we will go into the next step, which is cash flow from financing. Cash flow from financing activities. So first let's take a few examples, friends, of cash inflows from financing. What can they be? Issuing debt, issuing bonds. They basically mean the same thing. Issuing an IPO, issuing an FPO, issuing preferred stocks to selected investors, issuance of qualified. These are basically sources of cash inflow from financing activities. The first two that we spoke about were pertaining to debt, and the other three, IPO, FPO, preference shares, these are basically equity examples. Now we will talk about cash outflows from financing activities. This can be stock repurchase. In US GAAP, dividends paid. Then it can be debt repayment, etc. These are basically cash outflows from financing activities. You are repaying debt, you are repurchasing stock, you are paying dividends under US GAAP, that is considered a financing activity, like that. Now a few things we must take note of. Certain accounting changes have happened in IFRS. Because of these changes, it says that if there is a lease payment happening, there are two portions to it. One is the principal, another is the interest. The interest portion is basically an operating aspect, and the principal portion is a financing aspect. So this is a new phenomenon in IFRS. There are certain other nuances also in terms of differences. For example, if I draw two columns, IFRS and US GAAP, regarding interest paid, dividends paid, and interest received and dividend received, there are certain differences. For example, dividends received can be operating activities or investing activities under IFRS, but it is strictly operating activities under US GAAP. Dividends paid, it can be an operating activity or a financing activity under IFRS, but under US GAAP it is strictly a financing activity. Interest received can be an operating activity or an investing activity under IFRS. Interest received under US GAAP is strictly an operating activity. Interest paid under IFRS can be an operating activity or a financing activity, but under US GAAP it is strictly This is strictly an operating activity. So these are a few differences between IFRS and US GAAP, friends. A few more differences, friends. Taxes under US GAAP are considered under operations. Under IFRS also they are operations, but certain taxes, if they are actually related to investing or financing activities, if it can be established that they are directly related to them, then they can be categorized into financing or investing activities. In case of format, there is something called direct format of cash flow statements and indirect format. We'll get to that very soon, friends. But we want to highlight a little bit of the differences here. In both under IFRS and US GAAP, direct and indirect both are allowed. And direct is encouraged. Here also direct and indirect is allowed, but direct is encouraged. So this is a point of similarity, but when a direct method is used, that entails another statement or another explanation or reconciliation, which basically explains how net income has been translated to cash flow from operations. So net income has to be adjusted, and that adjustment has to be shown step by step, and we have to arrive at cash flow from operations. This reconciliation is needed when under US GAAP direct method is used. Majorly indirect method only is used. So now we will understand what is a direct method and what is a indirect method.